This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the unexpected just surged to levels not seen since the 2009 financial crisis. And this comes at a time when U.S. equity markets are surging to new all-time highs. And the Federal Reserve is championing their success of achieving a no-landing scenario. And yet, underneath the shiny veneer of the stock market, we find that the U.S. economy is in grave danger. Now let's head over to CNBC, where we picked today's story up with a headline: average credit card balances jumped 10% to a record 6,360, and more consumers now are falling behind on payments. And this is something that's perplexing, of course, to the political elite, who champion not only is the Federal Reserve achieving the impossible, but that Bidenomics should be helping every American. And if this was all working, then we should not see credit card balances surging at this point to new all-time highs, nor should we be seeing people fall behind on payments. Because what happens when people get behind on payments? Well, it tells us that the U.S. economy is headed into a recession. Americans now owe $1.13 trillion on their credit cards, as according to the Federal Reserve Bank of New York, as balances jumped 10% a year ago. Mind you, that's much higher than inflation, and this from a report from TransUnion, with the average balance per consumer hitting $6,360, also a historic record. And this is something that you only see right before a recession, is when credit usage actually gets maxed out. Because when consumer balance sheets are healthy, when people are making money, they tend to pay down on their credit cards a bit. They curtail their usage of it. They don't need them as much. But during periods of high inflation, when wages aren't keeping pace, that's where we tend to see a surge in credit card usage, right up until everything hits a wall and then the economy goes with it. And here we can see that it is a function of consumer prices that drives consumers to use credit, because they just don't have the income or resources to keep up with inflation. And we can note that periods where we see low inflation, as shown in red via the consumer price index, that following that, you see when a surge in inflation, what happens? A surge in credit card usage. You see that going to the global financial crisis. And of course, we see that right after the pandemic, when inflation took off, when we knew that wages were not keeping pace at all. Consumers had to look somewhere to maintain their standard of living. They turned to credit cards, and then eventually they turned to buy now, pay later loans, which all of this is coming due now. And what we see in the data is not pretty. It does give us an ominous sign for the U.S. economy, again, at a time when investors are only seeing green and the next bull market, while many Americans are seeing nothing but red. As consumers are just spending more, this from Charlie Wise, the Senior Vice President of Global Research and Consulting at TransUnion, even though the inflation rate is coming down, it doesn't mean prices are coming down. That is the key point, is prices are still rising, just at a much slower pace than before. And the fact that the economy is leaving so many Americans behind is one of the incentives the Fed has to get inflation down and get it down quickly. Because if they can do that, as of course we heard on 60 Minutes on Sunday from Fed Chair Powell, as he took a victory lap, as saying, I brought inflation down without impacting the labor market. But as we've noted on this show, that when you do bring inflation down, eventually the labor market does take a hit. The question becomes, is how do you know? Well, is the economy expanding or contracting? Well, when you see more and more people turning to credit and buy now, pay later schemes, and at the same time seeing delinquencies rise, well, it doesn't tell you the economy is exactly booming for everybody. And meanwhile, households continue to show signs of strain. Again, this is not what we should be hearing when we talk about Bidenomics, when we talk about a bull market in equities, as more cardholders are carrying debt from month to month or falling behind on their payments. Delinquency rates jumped across the board, as the New York Fed and TransUnion found, and delinquency rates surged more than 50% in 2023, and that's not a small amount. So when you think about why are people delinquent on their payments, it's because they don't have the money to make them, and that is the key point. In a healthy economy, yes, there are going to be delinquencies. That is just natural as part of our economy goes, but you should not see a big surge in them. So a surge of 50% over last year tells us that more American households are strained financially and trying to keep up with, of course, high inflation and slowing wage growth. And this is a serious issue because, according to TransUnion, serious delinquencies, or those 90 days or more past due, reached the highest level since 2009. Back when we were in a financial crisis, of course, what did we hear from Fed Chair Powell? And we've also heard from Janet Yellen in the past, is that we will not have another financial crisis in our lifetime. And yet what we're seeing more and more signs, not just from the commercial real estate aspect, but now from the consumer as well, that a financial crisis is inevitable. Consumers are struggling with their payments, and I think we'll continue to see those delinquencies tick up, and absolutely we're going to see them tick up. There's no question about that. But one thing that should be ticking higher every day, that's your trading account, because we just made trading a whole lot easier for you. And here you can see, looking from our trade, we talked about this in yesterday's show, now up 20.4% at the time of filming on our trade on QQQ. And we showed you how to use our reports. And look, if you're struggling financially, one place you shouldn't be is with your trading, because we do something that nobody else does. We give you the machine positioning, but one thing is unique is we do it on a historical basis. So when we show you that machines are at an extreme high or low, that means this is on a historical basis. When they get low, that's opportunity knocking for you. And we just made it easier because every day on page 1 of our reports, we show you when these different securities are coming off that extreme position. Now there's 5 coupon codes left for CTA Timer Pro for a free month. We did the same for Momentum Timer Pro. This is our tactical analyst report. You said, look, I'm looking at all these technical signals like the RSI, Steve, the MACD, and I'm in and out at the wrong times. Look, you forget that. On page 1, we show you extreme positioning on a 1 month window. When it starts to flip positive, that is our highest value signal. We just made this a whole lot easier. And again, 5 coupon codes for a free month, still available. Link in the description below. Check them out, because things for the economy are getting worse. But when it comes to your trading, well, should be getting a whole lot better soon. Because an additional 20.1 million new credit accounts were opened in the fourth quarter of last year, boosted in part by subprime borrowers looking for additional liquidity. And subprime generally refers to those with a credit score of 600 or below. This according to TransUnion. So you think about it, why are people out chasing more credit? Because they don't have money. And that is the key point of this economy right now. You see, on one hand, the people that own stocks and have assets, well, they're making money now, but a lot of people, a big majority of our economy is struggling financially. And if we leave them behind, if you think about it, if those people get left behind, well, their spending power goes. And next thing you know, eventually the stock market finds out that there is a big drop in revenues and earnings because people have stopped spending. They just don't have access to the credit. And many people in this group are millennials, unfortunately, who are burdened by high levels of student loan debt and the housing affordability crisis. If you can't afford to buy and your rent keeps going up, well, it's not a very happy set of circumstances. All of it, as we've noted on this show, will ultimately lead to less discretionary spending, which is a key focus of the economy. We need consumers to spend. That's how a debt-based economy works, is when people borrow money and go spend it into the discretionary side of the economy. This creates jobs, creates all kinds of prosperity. The problem now is when you run at the end of a cycle and you see wage growth declining, which is a problem. At the same time, you see credits maxed out. Well, it tells you the end of the cycle is soon. And student loan payments may be to blame for a spike in credit card delinquencies. This from Fox News, suggesting the credit card and auto loan transitions into delinquency are still rising above pre-pandemic levels. So you think back to before the pandemic, where were we? We were headed into a global synchronized recession. Now we have delinquencies at a higher rate than that. And what did we just hear from Fed Chair Powell? That the economy is booming. Why are these people behind on their payments? Didn't they see that the labor market is strong? Why are the Fed missing this? It's obvious they don't understand how the economy works. This signals increased financial stress, especially among younger and lower income households, is from an economic research advisor at the New York Fed, of all places. We do think the resumption of student loan payments is weighing a little bit more on that cohort. Again, they just don't see the reality of the economy. It's all, well, it has to be because of student loan payments. It certainly can't be for any reason that the Fed inverted the yield curves or money curves by driving short-term rates up and keeping them up too long. No, can't have anything to do with the banking system at all. It's got to be due to something else, because federal student loan payments restarted at the beginning of October after President Biden declined to extend the pandemic-era pause that first began in March of 2020 under his predecessor, former President Trump. Although payments did not officially restart until October, interest began accruing back in September 1st. Yes, is that a factor here? Of course it's a factor, but let's talk about the economy, because it's really what matters. If the economy was growing, if people were making more money and feeling more prosperous, they would be able to make their student loan payments. And in fact, they'd still be able to go out and buy things and do what they need to do. The challenge is the economy is going the wrong direction for many Americans. And here we can see the evidence of that when we look at total compensation in terms of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in blue on a year-over-year rate of change. And we have that against the delinquency rate on credit cards, which we now know is surging much higher than it needs to be. And lo and behold, what do we see? When total compensation growth decelerates, which is when the blue line heads down, what do you note? That delinquency rates shown in red for credit cards tend to go up. So as consumers have less money to spend, well, that turns out they have less money to pay on their debts as well. Again, you see the mirror relationship here during the global financial crisis. And look now, just again, as total compensation growth was slowing, people find themselves unable to make their credit card payments. So the issue here, is this really about student loans? Well, I think there's a small factor there for sure. This is more about the fact that total compensation, we keep hearing about, well, average hourly earnings is going up. That's wonderful. Except the problem is average hours worked is going down. People are actually taking home less money. Well, something's got to give. When your rent's going up, your food prices are going up, and your cost of everything else is going up, well, one thing you skip on is making your debt payments. And sure enough, the banks aren't helping out at all as we look at the net percentage of domestic banks tightening standards for credit cards, meaning as they tighten standards here, it gets more difficult. So if someone applies for a loan, well, there's a good chance that they're either going to get rejected or they're not going to get the amount of credit they're hoping for. And of course, when you do that, well, in a debt-based system, you need new debt to pay on old debt, and sometimes people borrow money to pay on existing debt. You see that relationship here as banks tighten standards for credit card debt. Anytime the blue line is over the horizontal black line, lo and behold, what do we see? Delinquency rates on credit cards indeed tick up. As again, people are having household liquidity crises here. That's what we're really seeing, is people are short money. They need it. They can't get it. And as a result, what we're starting to get to is not the hope of a no landing. We're running into the wall of credit that happens at the peak of every cycle. As this from Zero Hedge, a stunning collapse in credit card debt changes as average APR hits new all-time high. Let's look at the real issue here underneath, because back in December, households hit a brick wall because according to the latest consumer credit data published by the Fed, the last month of 2023, total consumer debt rose by a paltry $1.56 billion, which was not only nearly a 90% miss to consensus estimates of $15.9 billion. So what happens here is when consumers can't access credit, well, they stop spending. And then worse, as they see the economy slowing down and not moving into their favor, what do they start doing? They start to pay down their debt, because that becomes the focus in a debt-based economy. When people start paying down their debt and obviously not spending under the discretionary side, well, you've got all the recipe you need for a consumer-led recession. We see that here in this chart for revolving credit on a monthly change. What do we see going back during the financial crisis? We note the credit demand slowed as people are maxed out and just kind of gave up. And then as we headed into the recession, they cut their spending, started paying down their debt. And sure enough, we've seen some pops here in the data, some surprise numbers to the upside. Of course, what we note is that consumers remain optimistic that the economy is going to move in their favor, and they keep hoping it changes. The reality is, as we're starting to see, particularly with that total compensation data from last month, with hours worked getting slashed, the consumers are starting to realize the economy, for many, It's going the wrong direction. And are the banks going to offer any relief? Well, not a chance. This, according to the Senior Loan Officer Opinion Survey, over the fourth quarter, significant net share of banks reported tightening standards for credit cards and other consumer loans, saying, look, you may be falling behind, you may have a liquidity crisis, but don't come knocking on our doors because, well, we're not going to give it to you. While modest net share of banks reported tighter standards for auto loans, banks also reported tightening most queried terms on credit card loans. Specifically, moderate net shares of banks reported tightening credit limits, higher minimum required credit scores, wider interest rate spreads over the cost of funds, and tightening to the extent of which loans are granted to some customers that do not meet credit scoring thresholds. This is not good because regarding demand for consumer loans, well, when you realize you can't qualify, well, what happens is people give up. A moderate net share of banks reported weaker demand for auto loans, while modest net share of banks reported weaker demand for credit card and other consumer loans. That will put people in position to start paying down their debt. And what does this all mean? Well, let's turn to the UK economy because we can see now exactly where the US is headed next. Because more UK companies are going bust than any other time in 30 years. Of course, people are saying that we're not going to see 0% interest rates again. Well, good luck with that view, because when companies go bust, it tells you economies go bust. In this case, now we're talking not just how UK companies are going under, but how American households will be the next. And thousands of businesses have been pushed into insolvency. Again, just change the words to thousands of American households due to a combination of interest rates at levels we haven't seen in over a decade, pushing the cost of borrowing up and meaning there's debt service cost as well, alongside inflation, weak consumer confidence, and rising input costs. This is a perfect storm for financial distress. Again, you think about where American households are headed. Again, you talk about a grave situation for the U.S. economy at a time when everyone's looking at the stock market and saying, well, things must be great. Well, they're not great for many households right now. And despite more positive economic data, there's a growing divergence between companies. Let's just swap this out. American households capable of riding the wave of the recovery and those too entangled in financial or operational issues to benefit. This is the reality. There are some households benefiting from the rise in stock prices, thinking that everything's great, while many Americans are now struggling to pay their bills, heading into delinquencies. Those delinquencies eventually turn into defaults, and there goes your banks who are already about to start hemorrhaging from the commercial real estate crisis that is just brewing. And that all tells us that sooner than later, we're going to be in a financial crisis once again. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.